30th April 2022. Today we're going live here right now on Josh Tan. And just to start things with, yesterday I was at Hai Di Lao. And wow, it was really crowded. You know, all tables were packed. They were churning big amounts of profits. And even though there was a crowd outside, I could really see that the queue number was like going through the roof. And that goes to show, you know, businesses are really recovering. We're already thinking about everything that is pre-COVID. You know, we are so used to COVID. Now we don't need 1 meter spacing. Now we can eat in big groups. So everything looks to be good as new. And today we'll be touching on some malls, including the one which I just visited for Hai Di Lao, which is actually Vivo City. So if you're there, you see me, do say hi, and it's probably me that you see. So today, as usual, leave your questions below. I have a few coming in today, and I'll run through as many REITs as I can. I've planned 30 minutes jam-packed with information, and this whole event is totally free. And if you want to contribute, look for the Super Thanks sticker below, because any proceeds collected when you make a purchase of a Super Thanks sticker will be donated via the Josh Tan bursary. I think I haven't done that Josh Tan bursary too much service yet. I'm actually supporting 2 needy students. I've contributed $10,000 last year. Yes, $10,000 in donations, because I feel financial literacy and doing something meaningful for society as an influencer is important to me. That's why if you believe in that, if you have benefited from today, before you leave, buy a Super Thanks sticker. All will be forming part of this year's Josh Tan bursary funds, 10,000 to NTU at least. So without further ado, let's dive on to main parts, because I promised you something jam-packed. And yes, I do see comments coming in already. So I'll try to cover each and every one of them while I run through some of them where I have deeper insights, because that is going to link to some of the rest that you are interested in anyway. I'll start things with this. You know, we saw a big rout in technology yesterday. Amazon saw a big plunge. I don't know if you've seen it. More than 10% loss. What I want you to point you towards is REITs. That's why we're doing this Ask Me Anything, correct? So REITs is an asset class that does well with inflation. Inflation because some of the loans they can hedge through fixing that rate, correct? And when F&B businesses start doing well, like Hai Di Lao, which I went yesterday, they will naturally see more rental revisions upwards. I have numbers from Suntec. Just nice this period, a lot of REITs have released new performance numbers, so I have fresh information to share with you for today. But this graph is on iEdge S-REIT leaders. And as always, if you don't know how to, or if you don't want to pick particular REITs, go for the whole index, much easier. And what you can see is the index is relatively unscathed, correct? Everything is coming down, especially in the tech space. But for Singapore banks or Singapore REITs, you realize that it's business as usual. In fact, we need to start thinking pre-COVID, something I mentioned just now, which is, you know, 2019, we were not so much into technology. We were thinking real estate and stuff. But then when COVID hit, we assume technology is the best investment in the world and you never go down. Not true. Amazon's plunge is showing weakness in technology and a rotation out from tech growth to value investments, which REITs sits very beautifully. The REIT index has been flat for the last 3-4 years. You can go and check it out. If that's not value, I don't know what is. But this index is very important. It shows you where we are on this space right now. Let me start things with, there's quite a few questions. Wow. I try to pick as many as I can. So if I missed it out, I'll pick it up in the comment sections after the whole live stream. Let me start with Far East Hospitality. And the reason I picked this up to start our discussion rolling, because if you follow the channel, you know I'm big on hospitality. I've been calling Ascott Trust very early as my best dividend player. Ascott has appreciated 15-20%, thereabouts. But actually, if you see Far East Hospitality, as well as Fraser Hospitality, have both even probably done even better than Ascott, because Ascott is diversified, whereas these two have a bit more locally. I want to share with you my thoughts on them. The headline looks very nice. 17.2% growth in distributable income. So the main question is, should you get invested into Far East Hospitality? Because there was a question on the main channel. I'd like to answer this. When you pick a REIT, right, you need to feel a few parts. The first is, where is the sector going? Whether you're in data centers, whether you're in hospitality, you need to know the supply-demand dynamics, because you're renting real estate, correct? Hospitality means you're renting rooms. Data centers means you're renting space, or you're building and managing one entire location. So, or even for retail REITs, you need to feel the crowd. If you're doing office, you need to feel that the rental revision is going upwards. you need to feel the trend of the real estate you are owning. That's the first part. The second, we need to examine price to book. Where is it right now? Is it still of good value or not? And that's why I brought this up to discuss a bit further. What I want to show is Far East Hospitality has hotel rendezvous in Singapore. They are focused in Singapore with 13 properties. In April 2019, this was exactly the same price for Far East Hospitality. So right now, you see the price has recovered already, correct? If you look around many REITs, they are close to pre-COVID periods. But there are also differences where I'm looking at. And the quick answer to share with you is Far East Hospitality is something that I don't see a lot of good value. Why do I say so? Again, it's personal opinion. Don't take it as financial advice. Far East Hospitality, before COVID, had 13 hotels. Great. All Singapore hotels. Now it's on the uptrend. If we look in terms of numbers, just as a quick glance, of course, this is hard to crunch, you realize that we are still quite far for first quarter 2022 versus first quarter 2019. Gross revenue last time was 20.9 million. Last time was 27.7 million. Now it's only 20.9. We are playing a recovery story, which means we expect travelers to come in. In fact, Hong Kong, a lot of people don't dare to visit Hong Kong now because China has locked down and stuff, correct? Hong Kong expats have been coming to Singapore and they are snapping up service apartments where they also have. But when that trend is up, that's why I've been calling hospitality very early. Right now, I don't think it's that early already. The news that we're opening up is already baked in. You need to move ahead of where the trend will move. Then you make money, correct? That's why if you bought Ascott, where I mentioned a couple of months back, you realize that you are picking on this trend, the eventual opening of borders. And that has come true already. And now that borders have opened, you need to reconsider whether that is late. Because if you look at the price, it's the same as the pandemic. But again, Far East Hospitality is something different. They have 13 properties before the pandemic. And right now, take a guess how many properties they have. Still 13 properties. Every single REIT out there has been gobbling up properties because interest rates have been so low, correct? They've been acquiring properties. Everything is easily proven to be net yield accretive. But Far East Hospitality has not increased the number of hotels they own. So my question to you, if you're interested in Far East Hospitality, is what do you see as a potential? What do you see in this that can deliver you to 80 cents, for example? Because when you get in right now, you're getting a pre-pandemic price, and they haven't improved their operations. In fact, current numbers are still lagging behind pre-pandemic, which means they still have some run-up. But as of now, the excitement phase is already baked in. So my question to you is, if you're interested in this REIT, what are the key reasons? Now, let's move on to Suntec Reit. Maybe let me pull on some questions to quickly acknowledge some of the nice comments that have been sent in. Continue to leave them. Mapletree Industrial Trust. This is by Aaron Chia. So later I'll touch on Mapletree Industrial Trust because I like MIT, correct? So I have something interesting. So Aaron has also mentioned Samcorp Industries. Today we focus on REITs. I think we'll run out of time on REITs alone. But if I do have spare time, I'll touch on some other things that are not in the REIT space. Dennis, what are views on CICT and Fraser Mall? You know, I did a recent video on top REIT that's performed in the last few months. That is Suntec Reit. That's why I'll be drilling down on them. But they have similarities to CICT because CICT does malls, which is, of course, your capital malls, as well as offices. They are gobbling up offices in Australia, where Suntec has really done so. Fraser Mall, let me touch on it quickly. I think Fraser Mall, right? You see, Fraser Mall owns outskirt malls, which is North Point, which is Causeway Point. These malls work when we work from home, correct? Whereby if you go down to CBD right now, you are going from home, from Woodlands down to Suntec. You are no longer going to visit Causeway Point that much. That's my assumption to things. Of course, if it's crowded in Causeway Point, I don't know. I stay in Rio Valley area. I can't see Causeway Point. But my guess is Fraser's outperformance is due to work from home. The kicker is that if the kicker no longer exists, you need to challenge your desire to own it on what it can deliver further upwards. Another question on REIT. This is on Capital DC. Okay, I'll cover this. Oh, okay. I bought Capital DC at $2.10 just before, and now it's sinking. Let's touch on Capital DC in a quick while. But let's dive back to Suntec Reit. Because Suntec Reit, as you can see, right, I'll let you show you some numbers to things. Suntec Reit has 3 key components. You go and visit there, In fact, it's getting crowded already. I go there for lunch, I'm getting scared already. Suntec Reit used to be on my hideouts, less crowded, you don't queue. You see, Suntec has Suntec Office. They have overseas properties now in UK and Australia. And then they also have, of course, MBFC. They also have convention center, which I went to play badminton. Very expensive. if you like aircon, they're going to pay for that. And they also have the malls. I want to show you something. What do you see over here? Rental revision for the malls. This is Suntec Mall and Suntec Retail. First quarter 2022, no need to revise lower already. You see that? That also applies to CICT. I believe also to Frasers. Malls have been cutting rates because their tenants have been suffering. Hey, I'm F&B, but then my beer I cannot sell. But now, I go Hai Di Lao, there's a queue outside, don't need to space out some more. Everybody is going to revise back their mall rental rates. Singaporeans love malls. Not the lousy malls that are not in the MRT. We love to hang out in malls. We love to go Vivo City. We love to go Suntec City. We love to go Marina Square. Everybody is going to show rental revision upwards already. Just as we see on travel sector, we need to go in early. Now, this mall part, it's also no longer new already. But Suntec has the kicker, which is convention center. Conventions are still not baked in my opinion. That's why when I look at even Land Lease REIT, Land Lease Global, they bought GEM. That's fine. I suggested that price wasn't favorable to existing shareholders. But these malls all benefit with rental. Even for SPH REIT, SPH REIT is now acquired, or rather undergoing a general offer. But also, when we think about it, we need to think where is the kicker, correct? You want upside, you need to think where is market not expecting the full impact yet. Move ahead, then you be ahead of curve. It doesn't turn out, then that's all part of investing. So that's why Suntec REIT is proving rental revision is good. They also, let me show you this slide first. If you are concerned about all offices, because offices also include Keppel REIT. Keppel REIT has Australian offices, Singapore offices. You can check around. You realize that it's not true that office grade A is dropping. In fact, it's all doing fairly well. Everything is looking good in terms of numbers and occupancy. So what we can see also is that Suntec REIT's previous peak on the top left, I don't know if you can see, first quarter 2019. I'm going to do the homework for you. Suntec REIT itself was charging $9.37 per square foot. Right now, they are slowly recovering to that phase. There is still upside for offices in terms of supply demand, in terms of getting their office remodeled to the new economy, because everybody is slowly moving back to offices. Even though some might downsize, major banks might move out, but there's also technology that takes up space. So when you invest in the office REIT, you are now in the phase whereby things are recovering in somewhat. So let's go back to this. Let me drill with you a bit deeper on Suntec REIT. You realize that one thing that we need to also understand in terms of analyzing REITs is also what is the net asset value? Because are you paying a price that's over now, or have they actually shown some growth to things? You can see over here, Suntec REIT has grown their NAV. Previously, it was at $2.09. Then it grew to $2.11. Now it's $2.13, which means you buy now at $1.85. It is still at a discount to NAV. The thing you're riding is to probably a full 1 NAV. Then maybe that's where valuations are reached. So this question is, how did Suntec actually drive performance? Whereas, for example, Frasers, rather just now I mentioned about Far East, they haven't grown their properties, but Suntec has been acquiring properties in Australia and UK, something I mentioned. You realize that the leverage ratio, something mentioned over here, 43.3%. This is also quite a lot more. That means they are kind of no more room to acquire already. But the good part is when interest rates were low, they went to gobble up properties. That's what we wanted to see in terms of REIT managers. So over here, previously they were 38.6%. They went to gobble properties. Right now, they're more leveraged. Of course, you're concerned whether the interest rate go up. That's where you look at the fixed rate. How much is fixed? 51%. Previously, it was 77%. Hopefully, management goes and fix more interest rate, then that even does not become a problem at all. So there are some dynamics when it comes to thinking about the REIT that you want to own. Okay, so let's pull up some questions. Land Lease and Suntec, two REITs with explosive phase. Land Lease acquired GEM, just something I mentioned, and a lot of their fate now is going to be tied to GEM. Of course, Gem is a fantastic mall. If you are in Jurong, you love it. And it's also crowded, I'm sure. It's just that a lot of fate is tied to Gem right now. And the acquisition price, that is where the main question is. Because, again, they raised rights at 72.5 cents, where the IPO is 88 cents. We need to see whether the REIT manager is aligned and able to work hard for us or not. Let's put on EC. This is from Crystal. What is my view on EC World REIT? I don't know, actually. The good part is I know on some things well. Then some other things that doesn't catch your attention, maybe that's where, maybe if your input, can you leave them below? We can have a debate. But nothing in EC World REIT has caught my eye before to deep dive. So rather than give you a brief overview, maybe you leave to someone who has more insights on it. Okay, let's put up more questions. End of video. Which REIT do you see as undervalued? Along the way, I'm suggesting. Rather, I'm showing you my thought process. Not putting actual numbers to things like target price. I think is to remove away that interpretation that is a buy call. Because again, you do your own analysis. You think of what I suggested and make your own decisions. That's why I'm trying to avoid what I suggest outright, if you hear my tone of things. Let's put a last one before going back to the slides. Mapletree is merging. Still okay for investment. You see, right? Okay. I guess this question is regarding Mapletree North Asia Commercial Trust and Mapletree Commercial Trust, which owns VivoCity. To answer this question quite simply, if it's merging and you're unsure, and market is also unsure, why not stay out? Correct? The investment game is always there. We can't guess whether this is cheap, this is not cheap, because the market has already a lot of time to value that, which means it's likely correct value. The way I approach things is market is usually correct, only at extremes are they wrong. And right now, market is valuing Mapletree Commercial Trust at $1.90. So I think if you are not sure, wait for post-merger, wait for the dust to settle, something in July, then you look when you wait for opportunities, because now it's an enlarged entity. Of course, there are certain pros and cons which I've covered before, but if you're not sure, there are always different ideas that you can look at. Fair enough? Okay, so let's see some of the things. Now, let me end off Suntec Reit on this portion. You see that Suntec Reit has appreciated strongly over the last 3-4 months, correct? Year to date, fantastic returns after being flat. Why it was flat? Because it was bleeding money in convention center. The other REITs don't have convention center bleed. Now, conversely, convention center is going to be a plus. It's going to drive people to the malls itself. That's why Suntec Reit is appreciated. This current price at $1.84 is quite close to 3 years ago, pre-COVID price. And why was Suntec languishing right there? You go and check what they've been doing. At that point of time, NAV was shrinking. Suntec offices were dropping in terms of rent. That was a place and time where offices were not that sexy. That's why Suntec Reit was previously a premium to NAV and then started to become out of flavor. But right now, things are reversing. That's why this price versus the same pre-pandemic price is very different, because they've grown their DPU. They've grown their NAV. Now and then 3 years ago is very different. They have used the opportunity in the crisis to acquire. So again, same price, but momentum different. Where is max potential is also different. That's what I'm suggesting. Okay, so let's head on to, this is actually Ascott. Let me see if there's any other questions that I can also pick up on. And as always, leave your questions below. And just like I mentioned about the super thanks, super chat stickers, all proceeds raised from this free event will be towards the Georgetown bursary. I'm supporting 2 needy students from my old school, NTU. I'm committing 10,000. I committed 10,000 last year. I'll be committing 10,000 for the foreseeable years ahead via the Georgetown bursary. So if you appreciate it, purchase one super chat sticker or look for some of the courses, because I do teach investments also, as well as things that you find of value. Okay, so David has mentioned Fraser Commercial Trust. I think this is very similar to just now's question. ESR is doing a lot of acquisition. I think you're saying ESR Industrial. I wanted to pull on some data from Industrial. Just as a quick deviation, I saw on Channel News Asia a report that industrial rental rates have gone up. I've yet to verify that, which means that bodes well for ESR because they own a lot of old industrial. That's the old school thing. Or not, if you want, you go with Mapletree Industrial Trust because they own flatted factories and stuff and they are modifying things. So I like what they've been doing. ESR, I'm not sure if they've been modifying they've been trading properties or not. Then also Ascendas. And Ascendas owns business parks. They own industrials. And if that CNA data is correct, that industrial factories and stuff like industrials are showing increased demand, which means they are raising rates, then these could very soon see a revision from market sentiment. Okay, thanks, WK Low. So as usual, the super chat, super thanks stickers are below over there. Okay, let's go back to Ascott. Any fans of Ascott right here or not? If you are an investor in Ascott, because you saw my presentation there previously, do smash our thumbs up and do say thanks. Ascott has grown really well. Ascott, if you don't know, they own service apartments. And in service apartments, usually the contract is longer. Of course, they own hotels also. So when it comes to hotels in Singapore, Frasers, CDL, Hospitality Trust are more sensitive, whereas Ascott is very diversified. But if you like slow and steady, then of course, champion of hospitality, in my opinion. Right now, Ascott, they are buying a lot more into student apartments. You can see over here at the bottom left, Japan, they are buying student accommodation. They are going to become a very stable REIT there. Which means also, DPU growth won't have so much volatility. Whether there's a lot more upside, that's another question, because they have appreciated quite some bit already. I want to share with you, if you're keen on hospitality or Ascott, you can understand that a lot have master leases, whereby there's a minimum, which means they don't go into losses. Fantastic. Versus you buy, for example, Amara. Amara is a small cap hotel listed company. You might as well go with a REIT that has diversification, that have built-in master leases, and has a parent, which is CapitaLand, that is trying to do a lot of lodging. You see CapitaLand Invest, share price skyrocketed. Good remodeling of business, but they are also very focused on lodging, you realize. And then when it comes to lodging, I also want to highlight, if you're a fan of Ascott Trust, China's component is very small. So don't be too worried. There's a lot of lockdown in Beijing, Shanghai. It's true. Maybe business travel is going to halt again. But the rest, which is Australia, you see over here, the growth zone, right-hand side, Australia part, Australia is going to see recovery. That's pretty obvious. US, way ahead in recovery. UK, if you look at numbers, UK has been slow, very surprising. And I've put out actual numbers for you. Now, when we buy hospitality, the very interesting number, you see over there, revenue per unit. You see, right? How much do you pay for a hotel room? Have you gone staycation? Maybe I can ask you the question also. When I go, I booked something in Pan Pac, Pan, I paid $400+. But you see over here, revenue per room, $65. Wow. How is that the case? When you look at hospitality REITs, you need to look at this term, RevPAR. For them, they use RevPAR per unit. The others use per room. So for this, right, is to show you they have so many rooms, total revenue over total number of rooms. This is exceedingly low at 65. You pay $300-$400, but they only on average make 65, which means every 5 rooms, only 1 room they can rent out at the occupancy rate. This is going to flip very big. Previous numbers, pre-pandemic, it was 200 RevPAR. So you do see hospitality-wise, very easy to show operational number outperformance. But again, when it comes to investing, we need to look for market unexpected events. Are there big upsides? This rally has gone up already. Possibly it has some more, but how much more room? That myself, I'm also asking. Is there so much unexpected, or are we going to factor in very soon? So the surprise factor is where I'm concerned. But operation numbers are going to come in very strong in the next few quarters, in my opinion at least. So very interesting. See the RevPAR numbers. Look at Japan's. I don't know if I collated that or not. Japan's numbers, we have 24 minutes. Last 5 minutes. Wow. Maybe I could do longer shows. Japan's numbers, we all love holiday. Japan, Australia are top choices. Japan's numbers, I look at Ascott, super low, which means a lot more upside once we do traveling there without any quarantine period. So again, Ascott has businesses in Japan, small ones over here, but they do have master lease. Japan is a big component of Ascott Trust, and Japan, in my opinion, will recover very strongly in tourism. So let's put on some questions before I go to MIT. Mapletree Commercial Trust. This is from Mingley. What is my view on MCT? With the disruption coming in from MNACT, I think this is similar. At this phase, they are merging. Why not leave it to post-merger rather than justify that MCT is cheap? Let it merge first. When Grab did its spec listing overseas, Of course, Grab at one time showed fantastic numbers. But again, that specting is so murky. In investing, always be patient. There are other things. You can go with CICT, you can go with Suntec. There's no need to get MCT. That is my gut feeling. That's why I have not even looked too much into MCT's latest numbers too well. So let it settle. Let market decide whether its expanded mandate to invest in properties all over the world is beneficial or not. Let market tell you. What is my view on SPH REIT? Sell or wait for delist? I cannot give direct suggestions. But SPH REIT, quite simply, the main crown jewel is Paragon, correct? Indonesians are coming in. Rich Indonesians, we kind of know that. Travelers are coming in. So SPH REIT will show better numbers, but again, the same kicker. Suntec has a convention kicker. Where is SPH REIT's kicker? Because it'll be the same as Land Lease. Land Lease is just opposite. What's so different? SPH REIT hasn't really grown its properties in Singapore well. Land Lease at least went to acquire GEM. So I'm always looking for management to be able to grow the DPU. And SPH REIT hasn't really caught my eye. So that's my personal opinion on things. Okay, let's show from Crazy Daddy. I don't understand why REITs have not dropped when they yield 5%, but interest rates have better go 2-3%. What if interest rate going fast? This is a very typical concern on interest rate. Yesterday, I saw something from SGX, and Elite Commercial REIT was on that. My friend is actually part of the management team, so that's a cool story. So he has actually mentioned that they've actually locked in a lot on fixed rates. Same with your mortgage. You can go DBS to get a 5-year fixed loan, correct? REITs are also doing the same. So this concern of interest rate really is a side story. They have some that floats, that's true. But the bulk, if they really feel this concern, they can always lock it in. So even if interest rates spike up, you have some that's locked in for the next few years, no problem. And they have the kicker. The economy is doing well, especially if they have a retail malls, they are going to definitely benefit. So let's pull back. MIT. Let's dive on to MIT. Quite a few MIT questions. Winkit. And okay, let's go with that. MIT. Oh, I'm still on the same. Okay, so over here, right, I've actually narrowed the slides because when I do presentations, I like things to be concise. I want to speak to you more on things. So Mapletree Industrial Trust, if you haven't already seen them before, they are moving more towards data centers in US. Parent company Mapletree has been injecting a lot of data centers from US. In my opinion, as long as the numbers have been growing well, which I'll show in a quick while, that is a good REIT to own because you want to see growth, right? And you see the track record outstanding. The only problem with data centers is they are aligned with technology. Just now at the start of the video, I mentioned technology is in a possible out of phase. Overvaluation. Everywhere we see people are suggesting Google is cheap, Amazon is cheap, Tesla is cheap. That has been a narrative that's way too long already. We are anchoring the price at the peak. That's why a lot of reluctance to leave technology. But if you want to move ahead of curve, you need to understand that we might be past that phase. And equally, data centers are in that limbo because they are aligned a lot with technology space. But MIT is well run. And let me show you some numbers. What we want to see always is in terms of net property income, how they've been growing it. Small gains, you see over here, fourth quarter, this latest number came out a few days ago. So you see net property income, as long as it's growing, I'm quite happy to keep it. Versus Capital DC. Capital DC's net property income has dropped. And they've been paying out dividends from a higher ratio of payout. You know, REITs, they need to pay 90%, which means they have a liberty, how much? 91, 95. They can always pay a bit more and show you DPU growth. So you need to drill in on net property income growth. And everything in terms of where they show in terms of NAV growth must also be there to show you good performance. That's the key part of things. So when we look at MIT, right, we realize that the net asset value has grown also. So right now it's at 186. If you look across, only Digital Core REIT is close to NAV. You're paying a premium for MIT, you're paying a premium for Capital DC. And the usual concept is, maybe I wait until it's 1 times. But again, my guess is data centers, they are very undervalued. If they sell on open market, they can fetch a higher rate than what the property developer actually gives in terms of numbers. So the only difference for data centers, I believe, is we can pay a premium for it. It's just we need to see operational performance. And right now, MIT is delivering that. If you're a fan of digital core REIT, leave in the comment sections. I'll be keen to hear from you because I want to see track record in digital core REIT first before making full videos on suggestions on them. Okay, so let's one more questions as we try to round off this whole discussion. Hopefully you benefited. As always, smash the like button, smash the subscribe. Maybe every month I'll do a Q&A with you. Okay, this is from Crypto Lover. Held Suntec since 1:30. Oh, okay, good for you. Suntec has a lot of insider buying back in COVID period. You go and check it out, very interesting. Sing Hai's chairperson have been acquiring, and ARA being a parent, in my opinion, there's always this possible delisting competition. That's what I'm suggesting. Someone is acquiring stakes, Sing Hai's chairman. ARA also has a stake in it. Right now, chairperson is Madam Chew, who runs Straits Trading, something that I've invested personally myself. So there is big stakes inside. I always guess they might tussle in one fine day. Oh, Sengyi, hey, this is my friend. Thanks for showing your support. Capital DC. This over here, yeah, I've always suggested Capital DC is always acquiring properties. Just that I haven't seen numbers grow. They've only grown DPU. They didn't grow the operational numbers, which is a bit concerning. And I've ever seen a previous question. Maybe let's flash up the first one by Aaron. I think it helps to round up things. We've came close to the end. As usual, leave in the comment sections. Let's round up with Aaron's. When to exit? I think this is a good part. So I know when to exit. Aaron's asking when to exit a REIT. Let me share with you my approach to things. I would typically exit a REIT when, firstly, operation numbers are sliding. Capital DC REIT's numbers are sliding, for example. Hopefully they turn, which means when they turn and they are upward trend, we can reinvest in it. When the operation numbers are sliding, let that be a factor that sways you to probably exit. Second, is there no more kickers left? Something I've been re-echoing too many times a bit on this whole Q&A. If the kickers have all been expanded, then where is outperformance going to be? Then I'll even argue that you might as well go into, REIT Plus, where you get a whole basket, or the CSOP ETF, where you get a whole basket and no need to guess. Because there's no more kicker. When you buy individual REITs, you need to guess where's the kicker. That's something I've done continuously. I guess Ascott has a kicker through travel. I guess Suntec has a kicker through travel and convention. Then I don't see any kicker for Far East. That's why look to exit when you feel it's reached already. It has hit the NAV 1 times. Then possibly there are no more kickers. You need to look for alternative avenues. Because when you own a REIT, yes, you can always go with a dividend approach. That's true. But there are so many REITs to choose, correct? Surely there's some avenues. Maybe industrial regions are having kickers right now. I haven't seen numbers. The CNA report on factory numbers going up in terms of rental rate is interesting. Maybe that would pull up some questions that I see also on Mapletree Logistics, something I haven't covered before, very interestingly. This is Daiwa. This is Mapletree Logistics. I've seen, okay, Sanders. There. This is from John also, Mapletree Logistics. Hopefully, industrials do pick up, but Mapletree Industrial Trust can convert old factories to new high-tech buildings. I like that a lot. I think that sidesteps the old factory problem, like industrials. So as always, hopefully you've benefited from this quick smash and share session. I like doing this. It fuels the energy up. And as always, you benefited, look for Super Chat sticker or be donated via Georgetown Bursary. And as always, keep the comments coming. I'll see you in the next video. Invest safe, take care, and goodbye.